Hello and welcome back. I'm Benny Victory. Today we're going to discuss one more topic on the series that I started. Today we're up on number 3, and specifically what we're talking about are the false truths, myths, and misconceptions around reverse mortgage fallacies that some people cling on to. And when I speak to them, even though they understand and see the benefits of moving forward with the reverse mortgage, they seem to be kind of paralyzed and unable to take advantage of the features and benefits. And first we dealt with level 1, what I call level 1, which had to do with the old history of what reverse mortgages used to have. And we discovered and we went over those and we said that's the way it used to be and this is how it is now. Now we're on level 2 and we're tackling a series of false truths. Now what is a false truth? It's what people unfortunately and mistakenly believe to be true, but in actuality it's false. And whether they get that misconception through reading social media or it's handed down like folklore, they just kind of cling to it and they can't get past it. Today's topic is the idea that some people believe that if they get a line of credit or they get some money through the reverse mortgage, when that money runs out, they have to leave the home. Obviously, that's not the case, and nothing could be further from the truth. But I didn't want to just make a video and talk about the fact that it's a one-liner and it's a throwaway, that when you get a line of credit and you use the line of credit in any way that you want to, and you finish this line of credit, you don't have to leave the house. That's kind of obvious, and I wanted to take today's opportunity to discuss what I'm doing for a client and for you to be able to look at this example and see if it can resonate in your life and how would this scenario that is transforming their lives be able to be transformative in your life. So really, having addressed the topic rather quickly that your line of credit is yours for you to use, you don't have to make a monthly payment. Now I want to share with you what I'm doing for this couple and kind of give you a broad view and a scenario of what their situation is and use this as an example. So we appraised the property and the property appraised at $725,000. So here we have the $725,000 appraisal value. This couple, the husband is age 76, his spouse is age 73, and now we're in 2022. They owe $100,000 on their current mortgage. So in other words, we're coming in and they have a $100,000 balance on their existing mortgage, and that $100,000 mortgage is producing a monthly payment of $1,635. So we know that with the balance that they owe, in order for them to pay off this balance, it would have taken 5 years and 1 month. So in other words, the husband 76, the wife 73, neither one of them working right now and on retirement collecting Social Security with a small savings, in order to pay off this existing balance, they would have had to pay monthly payments of $1,635 for the next 5 years and 1 month. So what did we do? We shared and we had a conversation, we did our discovery, we found out what their needs are, what their financial cost of living is, and we saw that every month they're having to go into their savings to take some money out. So we put a proposal together and we said, with your $725,000 appraisal and your $100,000 current balance, what we could do is we could give you a new reverse mortgage in the amount of $350,000. So that $350,000, look at what it's going to be able to do and how significant its impact is in their lives. Okay, right off the bat, we're going to pay off the existing $100,000 mortgage. So that's the $100,000 mortgage that we have reflected on this line. Again, the vertical line is the money line, and this is time moving forward. That's why we have the husband and wife in year 22, husband 76, his spouse 73. So now we paid off the $100,000. In essence, what we're doing is we're starting on the money line at $100,000 over here. And we're giving them a line of credit for $250,000. Now at this point, this line of credit is what we call a standby line of credit. It sits there and all it does is makes $250,000 available so that this couple who use this money in any way that they see fit going forward into the future as they need it. Now, this $250,000 that's a standby line of credit, one of its main benefits is that when it's not being used, it's not accruing any balance. It's just like money sitting in a bank. In fact, what it is doing is that it's increasing at the current interest rate of the mortgage plus 0.5%. So if you think about it, let's say the interest rate is 4% on your $100,000 balance. That $100,000 at 4% is producing $400 of interest. So if they choose not to pay $100,000 and not to make a minimum payment and allow what a reverse mortgage to do, which is not be obligated to make a monthly payment, next month they owe $100,400. Okay? And I'm going to get to the bigger picture so that you see what the power of the reverse mortgage is in terms of the bigger picture. But this $250,000 that's sitting by and it's a standby line of credit is also accumulating at interest, but it's a positive interest that's available. Except instead of at 4%, it's 4% plus another additional 0.5%. So it's 4.5%. So $250,000 line of credit at 4.5% is roughly about $1,000. So this line of credit next month, instead of being $250,000, becomes $251,000. And every month that the line of credit is not being used, it's continuing to grow. Now, a couple of things. Why are we doing this, and why did we put this reverse mortgage in place for them right now? Well, if you think about it, in 5 years from now, they would have owned this property free and clear. And everybody would have been like, wow, Benny, that's fantastic. Oh, they only had 5 years left. Why didn't they just pay it off and be done with it? Well, let's talk about that. Okay, the husband is 76. In 5 years from now, he's going to be 81 years old. They're on a fixed income and they're not generating any new income from employment. So every dollar that's going towards paying this mortgage is money that's being taken out of their savings and their monthly income to make ends meet. Now, in 5 years from now, when they pay this property off, the property is still illiquid. It doesn't allow them to have access to any kind of money. It's just a house that they get to live in, which they could do right now with the reverse mortgage for the rest of their lives without having to make a monthly payment. Just simply by not paying 1 year's of monthly payment at $1,635, they're saving $19,620. That's $19,620 that wasn't used of their monthly income coming in to pay for this mortgage. That's $19,620 that they didn't have to go in and take money out of their savings account to help pay this mortgage. And in 5 years, that's obviously the $100,000. If you imagine that in the next 5 years, you didn't have to spend $100,000, whether that's money coming in or money from your retirement, your market accounts, your savings, that $100,000 is available for you to do anything else with. And you could still stay in place, you could age in your home, and you could stay there for the rest of your life. And now you use this money to make the necessary home improvements. You pay your property taxes, you pay your insurance. If you're in a condo, you pay your homeowners association. Everything else that you need to do, except you don't have to pay a monthly mortgage payment. Now, what does that do? That does a couple of things. Today, what it does is it protects your equity because we appraised a property for $725,000. That means that if in sometime in the future, 2 years from now, 3 years from now, property values go down and become $525,000, it doesn't matter to their line of credit, which we already established today, because that line of credit is now secure and in place. And unlike a traditional HELOC, a home equity line of credit that you may have had or you may have or are familiar with, this line of credit is never going to be reduced, closed, frozen by the bank. So even if property values that we appraised at $725,000 become $525,000, this couple is never going to get a statement from the bank saying, we're going to freeze your line of credit because we're concerned property values have gone down. And the opposite of it is true. If property values go up and the property becomes $925,000, then all that gained of property appreciation is theirs to enjoy and to do with. It's not a downside to them. But I want to explore this concept of the benefit of the line of credit a little bit more, because that's the biggest feature and benefit of a standby line of credit. This line of credit that we have, that we're talking about, that starts with the $250,000, this is money that is now in a separate account for them, and it's going to continue to grow at that monthly interest that we talked about, plus 0.5%. And if they use it, then the portion that they use will be added to the balance. So let's say, for example, they need to do a remodel of their kitchen, and it's going to cost them $5,000. And let's not even talk about the growth aspect so that the math becomes complicated. Let's just take it today. We know that they paid off their mortgage at $100,000, and then they have a $250,000 line of credit. So let's say they use $10,000 of this line of credit to do a kitchen remodel. So this $10,000 gets added to their existing $100,000 balance, and now their line of credit is $240,000. So a couple of things. We've started now here with $110,000. What do we know right off the bat? Well, we know right off the bat that they're not obligated to make a monthly payment on this $110,000. They could if they want to, but they don't have to. And if they don't, then that cash flow that they would have used to have to pay for the monthly payment is able to be spent on other things. Now, because this is a $110,000 balance and it's a reverse mortgage, what happens is that their balance is so low and their property value is so high. They have a $725,000. This balance, when it's starting, it is going like incrementally slow because it has such a low starting point. It's not like it's going to start here and shoot up. It can't, because it's such a low balance. So through time, they go, maybe they need to buy a new car because their car is old, or maybe they need to put a roof on their house. In other words, this line of credit is theirs for them to use. And as they use it, then they're starting to increase this balance. And if this balance increases, then slightly the balance of the loan is beginning to increase. But still, we have so much equity here that they're not eating into the equity. And you say, well, okay, well, they may be there for 30 years from now. What's going to happen in 30 years? What is going to happen in 30 years? What you're betting on is either property values are going to continue to appreciate or they're going to depreciate and come down. But what we do know is that this couple will be able to age in place, have monthly cash flow, and never be obligated to make a monthly payment against their mortgage balance. Now, at some point, if they decide to sell the house, or they've passed away, or they move out of the house, We look at what the property value is at that point. If the property values have gone down significantly so that they're upside down, in other words, the loan balance is over here and the property value is over here, we say that they're upside down. And let's say, for example, you're in a situation where your property values have gone down significantly and your property, as far as your loan balance has gone up, and let's say you're upside down $100,000. So this $100,000 is not their obligation. They could just simply walk away and not have to pay the lender any money, regardless of the fact that they've actually have stayed in the property so long and property values have gone down so low that they're losing money in the sense that they would have had to make the bank whole. Because of the FHA aspect of the mortgage insurance being in place, they could just simply walk away and not sell anything. Now, some people take offense to that and they're like, well, what about the inheritance? What about the kids? I respectfully take a different view on this topic. And I hold a strong view on this, and this is what I will share with you. Your home is your home. This is your biggest asset. You've earned the right to live and age in place in your own home. And if property values happen to go down and your inheritance can't be left because property values went down and you stayed in your home for the rest of your life without a mortgage payment, then so be it. I don't feel that children are entitled to get something just because of the fact that they're obligated, the parents feel obligated to give it to them. Because you have to look at the practical aspect of what a retirement can last. A retirement can last 20 to 30 years. That's 20 to 30 years that the parents are not receiving employment income. They're on a fixed income. And God forbid, when one of these two passes away, their income from Social Security automatically is going to be cut in half. So this monthly obligation that they have to pay is even more strained, even more difficulty for them to be able to pay that. Now, you also have their limited savings on the other side, and now the question becomes, with limited savings, half their monthly income cut, and to pay off a mortgage that they can't draw any money from so that their inheritance can be left over, that just doesn't sit right with me. I'm sorry. My own parents have a reverse mortgage. My father passed away 4 years ago, and when we bought the property 40 years ago, compared to where it appraised and how much we were able to get, and the fact that my mom at age 77 is able to live in the place and not have to worry about a monthly mortgage payment, is all the joy that I can ask for. Now, God forbid she passes away, whatever is left and we're given that money as inheritance from my siblings and I, that's a gift. It's not an expectation. I don't go to my mother and say, you need to get out of here so that I could have more money. I say, I'm so glad that you get to stay in the house and enjoy yourself. And whenever that is, that we get whatever it is, I'm grateful for it. It's not owed to me. So that's just my perspective, and I hope I don't offend anybody. But if the property values have gone up significantly and you sell your property, then obviously at that point, that's all the money that's left, whether for the homeowners or to give it as inheritance. What I want you to be able to take away with this example, besides the obvious answer to the question is that the line of credit, once you put it in place, it's protecting a couple of things. It's taking your property appreciation and taking it off the table so that it locks it in place regardless of property values going down. That's number one. Number two, the line of credit itself has a growth feature, and the unused portion continues to grow and increase, which gives you more money. Number three, if you look at how many years are left on your mortgage and what the monthly payment is, and you multiply that out by 1 year, by 3 years, by 5 years out, and you look at the significant amount of money that represents, And now that becomes money that you don't have to take out of your savings account, your money market accounts. That's not money that you have to reallocate from your income, but that's money that you don't have to pay, yet you still have the security and comfort of aging in place and staying at home and using that money for other expenses. Cumulatively, you begin to see the features and benefits that stack on top of each other with a reverse mortgage, and why it is such an incredible tool for seniors that are on a fixed limited monthly income and maybe even a very little savings. So when you understand that, and you understand that whatever your balance is that you're starting off, it's an incredibly slow growth rate that the balance is increasing, then you don't have to have this discomfort that all your equity is going to be eaten away and there's going to be nothing left. I hope this video is helpful to you and it's able to give you some fresh perspective and some food for thought to reconsider your particular situation. If we need to look at your example and look at your numbers and see what kind of a line of credit we could put in place, what it would mean to be able to pay off your existing balance and save that monthly payment, please contact me. I look forward to speaking with you. I thank you for your time, and thank you for being my client, and God bless you. Thank you.